Hello Accounting 101 students. In this video, we are going to go over some of the areas of focus in Chapter 5, which includes the perpetual inventory system, the periodic inventory system, for which you need to calculate the cost of goods sold, the multi-step income statement, gross profit, and profit margin ratios. For the income measurement, we start off with our sales revenue, and we're going to subtract out our cost of goods sold to get to your gross profit. From the gross profit, you would subtract out the operating expenses to get to the net income or loss during the period. And in a perpetual inventory system, the company has a system to maintain detailed records of the cost of each inventory purchase and each sale that occurs, which allows the company to know what is the amount of inventory on hand and determine the cost of goods sold each time a sale occurs. And this is different from a company that has a periodic system, which means that the company does not have a system to keep detailed records. So at the end of the accounting period, there needs to be a physical inventory count to calculate the cost of goods sold. And the calculation starts off by taking the beginning inventory, which is determined by taking last period's ending inventory. We're going to add our net purchases. So that's purchases minus purchase returns and allowances minus purchase discounts, and adding freight in to give us our cost of goods available for sale. We will subtract out the ending inventory determined by the physical inventory count to get to the cost of goods sold. So I have a practice problem that has an accompanying handout. And in this problem, we have Granite Hills Pro Shop that has cash, inventory, and common stock. And during the accounting period, they purchased some merchandise on account from Arnie Company for $1,500, and the terms are 3% discount if paid within 10 days, or the net amount is due in 60 days. Our journal entries to record this purchase would be a debit to inventory and a credit to accounts payable if you have a perpetual inventory system. If you have a periodic inventory system, your debit would be to the purchases account. The next topic is freight cost. We have FOB shipping point and FOB destination, which basically entails who is paying for the transportation of the goods. The way how I think of FOB shipping point is when a person is going to order a pizza and they're going to pick it up at the restaurant, versus FOB destination, which is kind of like pizza delivery. So in our example, Granite Hills Pro Shop, they paid freight. So they're paying for the item to get delivered to them. So they have to pick it up. So this would be an example of our FOB shipping point. And so we're going to debit inventory because Granite Hills increases their cost of obtaining that inventory by $80, and we're going to credit cash. We might be dissatisfied with some of the products, so there could be a case of a purchase return or an allowance. So in this example, let's say that we are returning some of that merchandise to Arnie Company. So for returning the merchandise, we don't want to pay for it. So we need to reduce our accounts payable liability with a debit and also reduce the amount of inventory that we have on hand with a credit. Another term you want to be aware of is purchase discounts. This means that the buyer can get a 2% discount if paid within 10 days. Otherwise, the net amount is due within 30 days. So just be aware of that when you have a cash payment. The other side of the transactions is recording sales. So when a company has a perpetual inventory system, there's going to be two sides. There's going to be a debit to our accounts receivable and a credit to sales revenue. And there's also going to be a debit to cost of goods sold and a credit to inventory every time a sale occurs. In our example, we sold merchandise on account to members. In this example, the members are our customers. So we're going to debit accounts receivable and credit sales revenue for the selling price. And we are also going to debit our cost of goods sold expense and credit inventory for the cost of that merchandise. If you had a periodic system, you would not do the second part of this journal entry. If we have purchased some items from a different supplier, we would record that as a debit to inventory and a credit to accounts payable. And in this transaction, we're going back to our prior transactions with Arting Company, and we're making that payment in full on April 14th. So it's important to do your journal entries in order of the problem. So on April 14th, we need to pay the amount that we owe to Arting Company, which is the amount of our purchase minus our return. We also remember that in our earlier transaction, there was a 3% discount if we paid within 10 days. So we're going to take the balance due of $1,300 times 3% to compute the purchase discount. So in a perpetual inventory system, that discount will be recorded as a credit to the inventory account because the discount reduces the cost of that inventory. However, in a periodic system, you're going to have a separate account for your purchase discounts, similar to having a separate account for your purchase returns and a separate account for your freight in. And for this payment, our cash amount is just going to be the dollar difference. So we're going to take $1,300, the amount that's due, minus that discount, and the difference is the amount that we need to pay in cash. This is a good time to pause the video and try to record the next 3 transactions on your own. After you've taken a chance to try those 3 transactions, here are the solutions. On April 17th, we're going to debit accounts payable and credit inventory. And this is for the return of some merchandise to our supplier. On April 20th, we're recording a sale to customers, which will have 2 parts of the journal entry under our perpetual inventory system. So we will debit accounts receivable, credit sales revenue for the amount of the sale, debit account or cost of goods sold, and credit our inventory for the cost of the merchandise. And our last transaction is when we're going to pay for that merchandise to Woods Sportswear. So when we're paying for the merchandise, we need to pay for the amount that is due. We're going to take the initial purchase minus the purchase return for accounts payable, recorded as a debit because we're reducing our liability when we're paying cash. We are going to reduce our inventory by the amount of the purchase discount by taking the amount due times the 1% discount. So you always want to make sure you pay attention to each problem and for each transaction to determine the percentage. And the difference will be credit to the cash account. So $800 minus the $8 discount. So one of the things that you want to be aware of is our net sales is computed by taking the sales revenue, which has a credit balance, minus the sales returns and allowances, which is a contra revenue account with a debit balance, minus the sales discount with a debit balance. And in this example, on April 27th, the company granted an allowance to its customers for clothing that did not fit properly. So we're going to debit the sales returns and allowance and credit accounts receivable. We're basically giving a discount or reducing the amount. The term for this is going to be an allowance because we're not going to receive the product back. We're just reducing the amount that they owe us. So that's one thing to be aware of. And our transaction on April 30th, now we're receiving payments from different customers for $1,220. So this will be the cash receipt recorded as a debit to cash and credit to accounts receivable. And once you go through all of these journal entries, you should be preparing T accounts. You're going to be taking the ending balance from each of your T accounts to prepare the trial balance using the Perpetual system. So one of the things you want to be aware of is in our Perpetual system, all of our inventory transactions are accounted for using the inventory account. And also at the end of the accounting period, you will know what your cost of goods sold is because it's recorded when every transaction occurs. When it comes to the periodic system, you will notice that you will have a beginning inventory account, but you also will have separate accounts for your purchases, purchase returns and allowances, purchase discounts, and freight in. And you will need to do a calculation for your cost of goods sold at the end of the accounting period. So I highly recommend looking at the handout along with the solution for this problem. And the handout compares the Perpetual system with the periodic system and how the journal entries are similar in most cases, but they are different when you have your transactions for inventory and cost of goods sold. And the last thing that you'll want to do as part of this problem is to prepare the partial income statement using the Perpetual system. One of the things that we talked about at the beginning of this video is in the multi-step income statement, we want to be able to compute the gross profit, which is going to be taking our net sales minus your cost of goods sold to get to your gross profit. And some of the ratios that you want to be able to calculate in this class is the gross profit rate and the profit margin. Thank you for watching this video.